Super. Good morning, everybody. My name is David McEvoy, and I work for Trust Merchant Bank out of DRC and out of London and Brussels in Europe. A little context first on the DRC and ASM and LSM mining in Congo. LSM mining is well established in the country. Approximately 120,000 people work in the sector. It's the largest contributor to the formal economy, the private sector formal economy in DRC. The ASM sector employs somewhere up to or over 1 million people. The ASM sector is primarily located in Eastern DRC, and much of Eastern DRC is classified as a conflict zone or a high-risk conflict zone. The LSM sector in the DRC is well banked, typically with provision made by some Pan-African or international banks that operate in the DRC. The ASM sector, however, traditionally has been entirely excluded both from the domestic and the international banking sector in Congo and in that part of Africa. So about TMB itself, and apologies, I just realized I've got the English version of the presentation up. One moment. About TMB itself, TMB is a financial inclusion-led bank. We came across financial inclusion maybe by accident. We were set up as a bank to provide facilities to the average person in the community without the concept of financial inclusion in our minds. We've been operating for about 16 years in the DRC. And today we are the largest bank in the country by coverage. So we have about 1 in 4, 1 in 5 bank accounts in the country. And we have about 110 branches across the DRC. You would think that we're a natural bank to provide or to look at services to the ASM sector, in particular when you consider that we provide banking services in marginalized and remote parts of the country into marginalized communities. And indeed, we provide services across northeastern DRC, which is a high conflict risk zone. So again, you would think a bank like TMB with our mandate and our mission would be open to providing service to the ASM sector. But traditionally, we've been very hesitant and very cautious about expanding into ASM. And there are two real reasons why we've not looked at the ASM sector traditionally up until quite recently. The first is compliance risk and reputational risk. The second is the matter of credit risk and how do we actually attract and provide a financing product to the ASM sector that's competitive in the market. On compliance and reputational risk, to give some context, the DRC is a largely dollarized or euro economy. About 90% of economic activity is denominated in dollars or euros. So for a bank like TMB, where our balance sheet reflects that, we have a very, very important reliance on the international and the international correspondent banking sector. The international banks in particular are understandably very cautious of both LSM and ASM. So we have to be cognizant of their view on the sector and their risk appetite. The fact is that if we've got a compliance or reputational risk matter or a problem in DRC, there is potential.
Do you see my screen? I can't hear from the room.
Yes, Julia.
Okay, perfect. David, I'm happy to drive it. I think you're on slide 4, and you can just let me know when to advance the slides.
Yeah, correct. I'm on slide 4 at the moment. So I was discussing how, for us, compliance risk and reputational risk is really, really important for the bank, given our key stakeholders. So in particular, the international banks that we transact or correspond through. Credit risk is also important because when we look at any new market or part of the economy, we're not interested. We want to provide the full spread of products and services that we would normally provide any client, and that includes financing. That'd be short-term and long-term client financing. And in the ASM sector, obviously credit risk is something that at first we thought would be extremely difficult to price. And second issue, whereby our entities would have no access to collateral that we could offset against any lending. Julia, if we go on to the next slide, 5, please.
Go ahead.
So about 3 years ago, TMB started was invited to participate in an access to finance pilot with the PPA, the Public-Private Alliance for Responsible Minerals Trade. And the pilot has been really useful for us in that it's provided us a significant amount of confidence building internally, and has given us access to key stakeholders, whereby we can develop our understanding of the ASM sector, the risks, the opportunities, and develop our strategy out of that access. For us, projects such as this pilot can come with grant assistance and aid, but the economics of the commercials weren't interesting to us. What was interesting to us was the access to key stakeholders and ability to build our knowledge of the sector. So really, the access to finance pilot has been a catalyst for us. It's unlocked our appetite and our capacity, and we've moved forward with our engagement with the ASM sector. Next slide, please. On the matter of credit risk, as we developed a compliance risk approach to understanding the ASM sector, we quickly identified and realized that as you collect compliance data in quite a thorough fashion, you actually collect a lot of data that's supportive of your credit risk approach too. So there's a strong correlation and positive correlation between high compliance risk scores or events at a potential client and creditworthiness. With regards to collateral, there are a number of programs that support lending by banks to the ASM sector, and this can be done through risk sharing facilities. So this has also given us confidence that we could start engaging with the ASM sector in terms of providing financing. We move on to the next slide, please. So our vision for financial inclusion. We've taken a compliance approach first, and I'll go into a little bit more detail on that, whereby we're giving ourselves the confidence from a compliance perspective that we can engage the sector, number one. So we're moving from a position of risk de-risking to one to risk mitigation. Our appetite is to support the formalization of ASM activities in DRC. We want to be able to assist in the increase of productivity and mechanization in the system. And we also are interested in securing higher ESG standards in the sector. We think that ASM formalization brings direct and indirect benefits both to the wider economy in those communities, to the bank itself, and to our LSM clients too, and that's of importance. And finally, a key point here is that the sector overall benefits from engaging with the ASM sector in a more structured format. And the reason I say that is banking sectors typically, certainly in Africa, assume they have no exposure to the ASM sector. In fact, banks in Europe would assume they have no exposure to the ASM sector, but that's a lazy assumption. And the reality is that ASM sector activity, one way or the other, finds its way into the banking sector or into the international banking sector. So to assume you don't have exposure is to be blind. And our message from that is you have to move from a de-risking to a risk mitigation approach to the ASM sector. So we move on to the next slide, please, Julia. Our strategy for ASM. Well, as I said, we're looking at providing all products and services to the ASM sector and to all ASM actor types, from miners to cooperatives, traders and exporters, and on all commodity markets. So we're agnostic. That being said, we've started first with the gold sector, probably the more difficult sector to start with, to really test our approach in terms of compliance, risk analysis, and credit risk analysis. We have a concept of also providing trade facilitation products to the ASM gold sector. And the reason we're broadening our offering is that we understand that at times the informal lending market might be more attractive than the formal lending market to ASM actors and entities. So we have to think creatively about ways or added products and services that we can bring in that makes the formal banking sector more economically competitive for ASM entities. On that note, we have, however, identified responses from clients in DRC whereby they're not solely focused on the pricing of financial lending products or financing products. They understand too that there are additional benefits to accessing financing from banks like TMB. So for example, lending is provided in a structured way, and more than anything, there's security of tenor. If we lend for a year or for 2 years, we're guaranteeing that that liquidity and that financing is available for 1 year or 2 years. We are taking a mobile banking-led approach to extending service into the ASM sector, and this is important for two purposes. Number one, it reduces the cost for the bank to extend service. And number two, mobile banking provides the bank with a high level of confidence in terms of financial flows and provides a lot of rich compliance data and credit risk data to the bank. We look at a kind of a vertical approach. So we would tend to seek to bank an entire chain from miner to exporter, and then lock up and lock in as much of the transaction flow as possible into mobile banking. What do I mean by that? Well, for example, in our mobile banking platform, we can define how funds that are flowing through the chain are spent or dispersed, or who the beneficiaries are. So on a miner or on a cooperative level, for example, you could define the beneficiaries of funds from those individuals or entities' accounts to being suppliers or healthcare providers, where you actually define and you lock in the individuals or the entities to whom funds can be transferred. So from a compliance point of view, you give confidence that funds are being used within the formal economy, and you quickly identify any instances where funds flow out of that vertical chain. In fact, it should be impossible, given the way we develop it within our mobile banking platform. So the key message here is that mobile banking provides high levels of confidence on the compliance side. It can allow you to have a very bespoke approach in terms of controlling or managing how funds flow through the bank. And it reduces the costs of extending coverage into certain communities. We'll go on to the next slide, please, Julia. So a key message at TMB is that oftentimes the banks think of compliance as a negative and as a cost. And we're trying to change the image, I guess, or the view of compliance within the bank and understand that compliance can be an enabler. So as I said, compliance generates, or compliance systems and reviews generate a lot of data that the bank can use. And we want to be able to use that to good effect, both in terms of compliance and reputational risk, but also in terms of increasing our credit risk capacities too. We've looked across the sector of the various different audit and certification and due diligence programs that exist in Congo that cover ASM. And we are aware that there are a lot of data out there. It's taken us a long time to understand the various different data providers and the quality of the data that exists. One thing that our approach is, one key area where I think the ASM, LSM sector and banking sector tends to differ is that banks typically won't rely on one data source to make a credit decision, and similarly for us to make a compliance decision. Whereas oftentimes what we found in the ASM sector is an entity will have an audit report or participate in one audit or traceability program. And generally to banks like to see a wider population of inputs into any risk analysis. Let's move on to the next slide, please, Julia. So to respond to that, we've developed what's called a TMB standard, whereby we're agnostic. We will pull in compliance data from as many sources as possible. And we define data into two types. One is an OECD silo, whereby we really look at data that speaks to, for example, human rights or governance and transparency of an entity. And the second silo is data that speaks to the ESG standards or performance of the entity. And out of that, what we were seeking to do is risk rate our clients or prospective clients from a compliance perspective. So if we look at the next slide, again, it just very quickly summarizes. We have two silos. One is, again, traditional KYC, and in the context of DRC, leans heavily on OECD due diligence. And the second silo leans heavily on IFC performance standards that speaks to ESG standards themselves. So if you go on to the next slide, we can skip that slide, Julia, apologies, onto slide, yeah. So we have examples here. So in KYC OECD, an organization fights money laundering, and in ESG, the organization commits to a reduction in greenhouse gases as examples of the different things that we will look to when we seek to risk rate a client or an entity. On to the next slide, please. So for that, we require a lot of data. That data are not always available. We understand that. So there's two elements to that. We don't expect perfection on day one. And number two, we are agnostic in terms of where we source our data from. We want to see data from as many inputs as possible. Next slide, Julia. We'll skip that slide on to the next one, sorry. This is an example whereby we've drafted a risk rating, a compliance risk rating for a client. So you'll see the different scoring that we apply to different areas of governance and transparency, and also to human rights as an example. And then the next slide shows how those final scores feed up into the type of products and services that we would provide to that client. So tenors of financing, how often they would have to have a due diligence recheck, for example. Next slide, please, Julia. Just some key points. Compliance. So we want to move from de-risking to risk mitigation, and credit risk analysis and credit compliance risk analysis helps you with that. Credit risk, it's something that compliance risk analysis can assist you with. On the point of the regulators, we think they can support lending to the ASM sector by reducing capital requirements for that lending activity, and also for a certain level of understanding that when things go wrong, there needs to be an approach of lesson learning rather than an approach of punishment, for want of a better word, and really look at what the aviation policy does in this area. And fourthly, last point is to discuss the matter of opportunities. We see that the ASM sector has a lot of opportunity for us as a bank, additional revenues, enhanced compliance capacities that we can use across the bank, reputational benefits. And also it works to broaden the economic base in rural areas. It's credit enhancing for other clients that we lend to. So there is a general and universal benefit to the bank to engaging in the ASM sector. One last point, in terms of the DRC, I think it's important to pick one or two champions in the market, one or two banks that are willing to run with it. Our experience is if you seek to engage the entire sector at one time, you tend to spend a lot of time and not get far in terms of progressing the ability to engage with the ASM sector. Apologies for running over, and thank you for your time.